everyone, welcome to my channel. My name is Teacher Ilona Smith. Today we're looking at the benefits of a company over other forms of ownership. So we're looking at your private companies, we're looking at your partnerships, your sole traders. So tune in and let's kick it. All right, let's get started. Benefits of a company over other forms of ownership. Here is the textbook that I've used to make the slides for today's video. I in no way take credit for the information in these slides. I've used the information as is from the textbook to make sure that I'm not changing the wording in any way. As we know, for business studies, we need to study it word for word and write it word for word. Therefore, if I change the wording, it could disadvantage learners. So I've kept the wording as is, and I've made use of the textbook to make sure that the information is accurate and relevant. All right, forms of ownership. Forms of ownership refers to the legal requirement of a business and the way that it is owned. An entrepreneur must decide which form of ownership will best suit their type of business. There are 8 forms of ownership, and they are summarized in the diagram below. Okay, so we can see there we have profit companies, and then we have our one non-profit company. All right, sole trader, the definition. So just note it says sole trader and sole proprietor. They mean the same thing, so it doesn't matter which wording you use. What I would suggest is try and pick one and then use that one throughout with your exams. All right, sole trader. This is the simplest form of business ownership where an individual is responsible for setting and running a business. A sole trader manages all the investment, the risk, and the returns of the business. They are working alone. It is only them. They don't have any employees. They are just them by themselves. The characteristics of a sole trader. A sole trader is a business that is owned and managed by one person. Assets and profits in the business belong to the owner. Legally, there is no separation between the business and the individual running the business. If the business is facing legal action, the owner is held legally responsible for the debts of the business. The sole trader does not pay tax, as the owner will pay tax in their own personal capacity. The profit made by the sole proprietorship is added to any other income by the owner, and SARS will then calculate the amount that's payable. There is no legal and administration formalities in the formation of a sole trader. So you can start a sole trader today. You don't have to register the business. You might want to register the name though, just in case someone else uses the name. But you make all the profits, you carry all the risks. It's all on you. A sole proprietor is not a legal entity, and agreements entered into it by the owner are in their personal capacity. Businesses have unlimited liability, and the private possessions of the owner can be used to pay for the debts of the business. So we're going to get to the advantages and disadvantages, but one that is definitely tricky with a sole trader is if the business is struggling and there's debts to be paid off, they can come to your house, they can take your couch, they can take your furniture, take your TV in order to repay those debts. Whereas with a company that's registered, they can't do that, because if you think of legal identity, so a sole trader, they're seen as one of the business. So the business and them are one person. So if the business is only owing money, that person is owing money too. Whereas with a registered business, it is separate identity and entity. Therefore, if the business is owing money, it's the business itself, not the owner of the business. All right, the advantages of a sole trader. The owner can simply start the business anytime they want to. Why? Because we said there's no administrative and formalities. The business is run as the owner sees fit. Assets and profits of the business belong to the owner. The owner makes all the decisions that affect the business. The business requires little capital to start. This form of ownership has a simple management structure. It can easily adapt to the needs of the customer. No legal process or requirements are involved. The owner is responsible for providing all the capital needed. Why are they responsible? Because they are working alone. It's just them. There is personal encouragement and personal contact between the owner and customers. Then the disadvantages. The owner contributes only their skill, time, and energy to the business. The business cannot continue to exist if the owner dies or retires because they are the only one part of the business. Capital is limited to the amount of money the owner has access to. Unlimited liability, which means the owner is responsible for all the debt incurred by the business, meaning again, if the business is owing debt, they can come and take your couch. The couch is just an example. Just bear with me, guys. I mean, obviously they can take other stuff, but I like to just use the couch as an example. They can take your car as well because that's an asset. Cash flow is often a problem because they're the only one. Growth of the business can be restricted due to the lack of capital. There is no legal identity and no continuity. Continuity meaning if the owner dies, the business falls away. It's difficult to attract highly skilled and knowledgeable employees. The owner is responsible for providing all the capital needed. If the owner does not have enough knowledge and experience, then the business will fail. Now we're looking at partnership. The definition. Partnerships are owned and managed by two or more individuals who have agreed to set up and run a business. The individuals are called partners. There is an agreement between partners on how they will share the profits of the business. Now we're looking at the characteristics of a partnership. A partnership is an agreement between two or more persons, so you can even have up to 6 people in a partnership, just as an example. Each partner will contribute to the partnership, so what they will contribute is their skills, resource, or money into the business. Profits or losses are shared amongst partners according to the partnership agreement. Partnerships are not legal entities, which is similar to sole traders. This means that the partner does not pay tax in their personal capacity. Profits are divided amongst partners in a ratio as agreed to the partnership agreement. So the ratio can either be 50-50, it can be 70-30, but it has to be agreed upon. So whatever profits are made is split amongst that ratio between all the partners. The more partners you have, obviously, the more the profits being split, which means the smaller amount of profit you actually will be making. But on the other hand, the more amount of partners, the more capital can be provided, the more knowledge and skills there are in the business, which could help the business. So I think that's why, again, we need to weigh up what type of business we want to run and how do we want to run it, which will help us decide which form of ownership we will choose. There's no legal entity regarding the name of the business. There's no legal requirements regarding the name of the business. What that means is you'll see when we get to private companies, they end with Pty Ltd. Public companies end with Ltd. We don't have to have a partnership ending in any requirements because they are not legal entities. Partners have unlimited liability and are jointly, severally liable for the debts of the business. The auditing of financial statements is optional. Partners share responsibility and they're all involved in the decision making. There's no legal formalities to start this type of company, only the written partnership agreement, which will show the contributions by every partner and obviously the split of profits and losses. Partnerships have no legal personality and therefore there's no continuity when a partner leaves the business. Okay, similar to a sole trader, if a partner leaves the business or a partner dies, a partner retires, in order for the business to essentially continue, I'm using this because it's not really continuing, we need to form a new partnership agreement, which would mean that it's not actually the same partnership. So I think if you have a partnership, let's say Becky's in it, Sipo and Zizi, you've got those 3 in the partnership. So if Becky passes away, we have 2 other people. If they start a partnership, obviously it's going to be different because now there are 2 people and not 3 people in the partnership. Oh yes, and the word personality, it doesn't matter in your exam and test if you use the word legal entity, legal personality, legal identity, they all mean the same thing. I just noticed that in the textbook they use them all differently, but it means the same thing essentially. Partners require responsibilities and they're all involved in decision making. The legal liabilities lie with the partners and they cannot shift the liability to the business. So once again, if the business is owing money and the business is in debt, they can come and take your car, take your house, take your couch. Gotta love that couch that we're taking. All right, advantages of a partnership. All partners contribute to the business as responsibilities are shared amongst the partners. Partners can deal with the problems together, so it's a bit better than a sole trader because now we have more people to share their expertise and knowledge. A partnership can easily come into existence because we said there are no formalities besides for that partnership agreement. The partners are able to put their knowledge and skills together to collectively make the best decisions. The workload and responsibility is shared amongst the partners, making it a bit easier. The partners are able to share the resources. Partners are only required to pay tax in their personal and individual capacity. The partners have a personal interest in the business. The partners can bring in extra partners at any time. Attract prospective employees with the option or incentives of becoming a partner in the business. Partnerships are relatively and easy to establish. Partnerships contribute new skills and ideas into a business. Partners share responsibilities for decision making and managing the business. Partners share any profits and therefore are motivated to work harder because the harder they work into this business, the more profits they could be reaping as a reward. Raising additional capital to finance further business expansion is easy as there is no limit on the number of partners we can have. Partners are taxed in their personal capacity, which could mean that there could be lower taxation. The disadvantages of a partnership. Partners do not always agree, and this can slow down decision making. A bad decision by one partner can lead to the losses of the partnership. Partnerships must dissolve if one partner dies or retires. Like I said, yes, the business can essentially continue, but the partnership is not going to be the same because it's not the same people that started it. A partnership has unlimited liability, so all the partners are liable for the debts if the business becomes insolvent. Each business partner is legally responsible for their joint liability of the partnership. Different personalities and options of partners could lead to conflict and disagreements. Disagreements can occur because of shared decisions. Partners are jointly and individually liable for the actions of the partners. Profits must be shared with others, so it's not like a sole trader where we can hold all the profit. Here we have to split them according to the ratio. The partnership must have a limited lifespan upon the withdrawal or death of a partnership. Loss in profits and stability of the business can occur if a partner resigns or they lose interest or they pass away or is declared bankrupt. There can be a lack of capital and cash flow. Partners might not all contribute equally. So you might have, which I'm sure you guys have experienced if you're doing projects in school, you might have one partner that contributes so much capital, money, equipment into the business, and another partner that just sits back and relaxes and just reaps all the profits and the rewards and doesn't contribute a thing. All right, closed corporation, CC. Definition of a closed corporation. An optional association of one or more persons, but it cannot exceed 10, who qualify for a membership in terms of the Act of 69 of 1984 and secure its incorporation. The new Companies Act does not make it possible to register a closed corporation. However, existing CCs may continue to trade. So it was quite a couple years ago, I think in the late 2000s, like before 2010s, or it was early 2000s, where they actually stopped new CCs from being registered. But if you had registered your business, it could still continue as normal. But unfortunately, you can't register a new CC. I'm not too sure of the exact reason why. Maybe it could be something interesting to go and research and go Google about. But if you see a company that ends in CC, just know that company's probably been around for a long time, because no new CCs can come into effect. All right, characteristics of a closed corporation. Appropriate for small or medium businesses. CCs are legal entities, meaning it has legal rights and responsibilities, which also I think we're going to get to further. Because it's got its own legal entity, it means it can't come to our house and take our couch or our car or TV. CCs, it can have a minimum of 1 member to a maximum of 10 members who share a common goal. The word close means that all members are involved and take part in management. Each member contributes some as set services towards the corporation. The name ends with the suffix CC. That's why you'll have the name. Sammy's Construction CC. It has to end with CC. Members have unlimited liability, except where the CC had more than 10 members for longer than 6 months or longer. A CC has its own legal personality, and therefore it has unlimited continuity, meaning if a member dies or retires, the company can still continue. The auditing of books is optional, as members only need an accounting officer to check their financial records. Transfer of a membership's interest may be approved by all other members. Profits are shared in proportion to the member's interest in the CC. Then we have the advantages. There are a few legal requirements. So, for example, auditing of financial statements and regular annual general meetings. A CC has legal entity and has continuity of existence. It can be converted to a private company and members may become shareholders. Members have limited liability, meaning again they can't come and take your personal stuff if the company is in debt. Owner's interest in the CC does not need to be in proportion to their capital contribution, so it can be different. So this person could contribute more than another person. CCs may be exempt from the Companies and Intellectual Properties Commission from auditing its financial statements. Then the disadvantages of a closed corporation. There's limited growth and expansion since a CC cannot have more than 10 members. A member of a CC can be held personally liable for the losses of a CC if the member's actions are incompetent. Audited financial statements may be required when applying for a loan. A CC is taxed as if it were a company, which may be higher than personal tax rates. It's difficult for members to leave a CC as all members must agree to dispose of this person's interests. A CC is taxed on its income and standard of tax company based on the member's dividends. This can lead to double taxation. Now we're moving on to a private company. A private company is a company that restricts the right of its members to transfer shares and does not invite the public to subscribe. A private company uses the word proprietary limited, PTY, Ltd in its name. So again, it needs to have the name and PTY Ltd at the end of its name. Characteristics of a private company. It requires 1 or more directors and 1 or more shareholders. It needs a minimum of 1 shareholder, and there is no limit on the number of shareholders that a private company may have. A private company is not bound to publish a prospectus when issuing shares. A private company is subject to many legal requirements, such as it needs to be a registered company, the name needs to be registered, there are certain formalities and documents that are needed in order to start a private company, which in contrast is different to a sole trader or a partnership. A private company is not allowed to sell shares to the public, so it can sell shares, but not to the public. A minimum of 2 shareholders is required for a meeting, except in the case of a one-person company. Register with the Registrar of Companies by drawing up a Memorandum of Incorporation. So again, there is where the formalities and admin comes in play. Annual financial statements must be audited with some exception in the terms of the New Companies Act. Private companies do not offer securities to the public. Securities, it's another word for shares. Shareholders have limited liability for the debts of the business. So if the business is owing debts, if the business is bankrupt, they can't come and take your personal belongings. Investors put capital in to earn profits from shares. The company has a legal personality, which means it has unlimited continuity. If a person dies or retires, the company can still continue. Shareholders have limited liability and will not lose their initial capital invested if the business goes bankrupt. Shareholders have limited liability and a separate legal entity. Raising capital by issuing shares to shareholders is possible. Profits are shared in the form of dividends in proportion to the number of shares that are held. Now we're looking at the advantages of a private company. More capital can be raised by a company than by an individual. Auditing of financial statements is voluntary. It's not necessary to appoint an auditor, an audit committee, or company secretary. More opportunities to pay less tax is available. Good long-term growth opportunities are also available. Own legal entity and shareholders have no direct legal implications, meaning there's limited liability. Again, they can't come to your house, take your personal belongings like your couch and your TV. Board of directors with expertise or experience can be appointed to make decisions. It's not required to file annual financial statements with the commission. It is a legal person and therefore you can sign contracts in its own name, meaning the company, right? The new act forces personal liabilities on directors who knowingly participated in conducting businesses in a reckless or fraudulent manner. Financial statements are private and not available to the general public. A company has continuity of existence, meaning if someone dies or retires, the company can continue. It is possible to sell a private company as it has its own legal entity in its own right. It can easily raise capital by issuing shares to its members. Now we're looking for the disadvantages of a private company. It is restricted from raising funds directly from the public. Costs and formalities associated with forming a company, which is different to a sole trader. Tax is paid on taxable income of the company, and companies pay secondary tax on dividends distributed to shareholders. It requires a lot of capital to start up a private company. The more shareholders there are, the less profits are being shared. There's more taxation requirements than that of a sole trader. Directors do not have a personal interest in the company, as they're not really working for the company. They're just either having shares in the company or they've just provided capital to the company. Annual financial statements must be reviewed by a qualified person, which is now an extra expense to the company. It's difficult and expensive to establish as the company is subjected to many legal requirements. Plus, there is tax on the profits of the business and on declared dividends, so they could be subject to double taxation. They must prepare annual financial statements. Now we're looking at a personal liability company. The definition. A personal liability company is, let's not confuse this now, it is a private company, but it is mainly used by associations such as lawyers, engineers, and accountants. The company name must end with the words Incorporated or INC, Inc. It runs on the principle of personal liability. This means that the directors of the company, as well as previous directors, will be responsible for the debts of the company. Now we're looking at the characteristics. One or more persons may incorporate a personal liability company. The board of a personal liability company must comprise of at least one director, so it needs to have one director, and we said one person to start the company. Personal liability companies are subject to fewer disclosure and transparency requirements. It is governed by the Companies Act and incorporated in terms of the Memorandum of Incorporation. The Memorandum of Incorporation gets dealt with further in this chapter. We will deal with it in detail and discuss it. The directors are jointly and severally liable for the company and for all company debts and liabilities occurred. Certain professional persons, such as attorneys and accountants, who are statutorily prohibited from enjoying limited liability, often incorporate a personal liability company to regulate their affairs. The company has the benefit of corporate existence and perpetual succession. These companies are identified by the suffix incorporated or inc, so it needs to end with that, the name of the company. A personal liability company is prohibited from MOI, Memorandum of Incorporation, from offering its shares to the public, and transferability of its shares is restricted. So just like a private company, they also can't offer their shares to the public. A personal liability company must prepare annual financial statements, but it is not required to lodge an annual financial statement with the Commission. Annual financial statements need not to either be audited or independently reviewed unless it is prescribed by regulation. Shareholders of a personal liability company have the right to preempt in respect of the issue of new securities unless the MOI provides otherwise. A personal liability company has a separate legal personality, and therefore shareholders have limited liability. Same as a private company. If the company is in debt and the company is bankrupt, they can't come and take your personal belongings. A personal liability company is required to give 10 days notice for a shareholder meeting. Now we're looking at the advantages. A personal liability company is subject to fewer disclosure and transparency requirements, making it, I don't want to say the word, but perhaps a little bit easier to establish. The board of a personal liability company must include at least one director and one other minimum number as stipulated in its MOI. The lifespan of a personal liability company is continuous, so if someone dies or retires, the company can still continue. Directors of a personal liability company are compelled, so they have to, attend the annual general meeting. Audited financial statements are optional. Otherwise, the financial statements need to be independently reviewed unless exempted by regulation. A personal liability company does not have to lodge its annual financial statements with the Commission. Shareholders of a personal liability company have the right to preempt in respect of issues of new securities unless the MOI provides otherwise. So again, securities, it's just another word that they're using nowadays for shares. The Act imposes personal liabilities on directors who are knowingly part of a reckless or fraudulent business. Then we're looking at the disadvantages of a personal liability company. It is difficult and expensive to establish a personal liability company compared to that of a closed corporation and a sole proprietor. Large management structures can result in decision-making taking time. The personal liability company is not allowed to sell shares to the public. Directors may sometimes act in their own interest and not in the best interest of the company. Annual financial statements must be reviewed by a qualified person, which is an extra expense. It's difficult and expensive to establish a company, and it is subjected to many legal requirements. It pays tax on the profits of the business and on declared dividends, which means it could be subject to double taxation. Directors of the personal liability company have unlimited liability. Some shareholders may not exercise their voting rights, resulting in choosing the wrong person as a director. A meeting may not begin or a matter may not be debated unless at least 3 shareholders are present. It is restricted from raising funds directly from the public. Costs and formalities associated with forming this company could be a disadvantage, because we mentioned that they are higher than a sole proprietor. Tax is paid on taxable income of the company, and companies pay secondary tax on dividends distributed to shareholders. All right, a public company. A public company has continuity of existence. Again, within the meaning, if someone dies or retires, the company can continue. A public company must appoint an auditor, an audit committee, and a company secretary. The company's name needs to end with the letters LTD, meaning limited. Definition of a public company. A public company is a company that is registered to offer its stock and shares to the general public. This is mostly done through the JSE, which is the Johannesburg Securities or Stock Exchange. The public company is designed for a large-scale operation that requires large capital investments. Characteristics of a public company. A minimum of 1 person is required to start a public company. It requires 3 or more directors and 3 or more shareholders. It needs to register with the Registrar of Companies by drawing up a Memorandum of Incorporation. The name needs to end with the letters LTD. It has legal personality and therefore has unlimited continuity. It raises capital by issuing shares to the public and by borrowing capital by issuing a debenture. A prospectus is issued to the public to raise capital. Shareholders have limited liability. So again, with this example, if the company is in debt or insolvent, they can't come and take the owners and the shareholders' personal belongings and stuff. The new act forces personal liability on directors who knowingly take part in conducting business in a reckless or fraudulent manner. The company has a legal personality as well as unlimited continuity. A public company is required to hold an AGM, an annual general meeting. Auditing of financial statements is compulsory, and audited statements are available to shareholders as well as the public. Profits are shared in the form of dividends in portion to the share that is held. Now we're looking at the advantages. The business has its own legal identity and can own assets and property in the name of the company. There's no limitation on the number of shareholders, so growth and expansion is not limited. Competent and knowledgeable directors may be appointed by shareholders. It's easy to raise capital as large amounts of capital for growth through the issuing of shares to the public. Competent and knowledgeable directors may be appointed by shareholders. Shareholders have a limited liability for the debt of the company. Shareholders may only lose the amount that they have invested. It attracts small investors as shares can be transferred easily and freely. Shareholders can sell or transfer their shares freely. The public has access to the information as financial reports must be published annually. This could motivate the public to buy shares from the company. Strict regulatory requirements protect shareholders. Additional capital can be raised by issuing debentures to the public. The company keeps its shareholders regularly informed about its performance, shared values, and the future. Disadvantages of a public company. Tax is paid on taxable income of the company, and companies pay secondary tax on dividends distributed to shareholders. It's a complicated process to incorporate or start a public company. They must appoint an auditor, an audit committee, and a company secretary. A large amount of funds is spent on financial audits. Stocks have to be traded publicly. Stocks, shares, securities, we're all talking about the same thing here. A full report must be submitted to the major shareholders every year. It's difficult and expensive to establish as a company as it's subjected to many legal requirements. The more shareholders, the less profit is acquired. Shareholders may be allowed little or no input into the affairs of the company. Due to legislation, decisions take longer and therefore there may be disagreements because there's a lot of shareholders, so they all get to take part in the decision making. I think it depends mainly on how many shares they have in the business and the percentage. Financial affairs must be known publicly. This information could be used as the competitor's advantage. Now we're looking at state-owned companies. Okay, we had private company and personal liability company. They are similar but not the same. In this one, we've got state-owned and public company, similar but not the same. Just be careful because I know learners confuse these a lot. All right, the definition. A state-owned company has the government as its major shareholder, and it falls under the Department of Public Enterprise. Okay, state-owned companies, before we go any further, we can think of Transnet, Eskom, the likes thereof of those companies. They are state-owned, whereas Coca-Cola in South Africa is a public company because it offers its shares online and it doesn't communicate or speak to the department and municipalities. Characteristics of a state-owned company. It requires 3 or more directors and 1 shareholder. It needs to register with the Registrar of Companies by drawing up a Memorandum of Incorporation. It is owned by the government and operated for profit. SOC is listed as a public company. That's where I said don't be confused. The company is owned by the government or municipality and otherwise is similar to a public company. A state-owned company has financial autonomy because they are dependent on the government for initial investments. The name of a state-owned company must end with the letters SOC. State-owned companies support private businesses by supplying infrastructure such as communication services, post offices, and supply of electricity. State-owned companies are subject to disclose and transparency requirements. Information in the state-owned company is available to shareholders. All distributions to shareholders require board approval and need to satisfy the solvency and liquidity tests. Distributors are unfortunately extremely widely defined and include dividends and share buybacks. Payments will be according to the class, preference, rights, and limitations of shares held. The new takeover regulation applies to every state-owned company unless it is exempted by law. State-owned companies must give 10 days notice for shareholder meetings. A state-owned company must implement a reporting process for whistleblowers. Advantages of a state-owned company. Profits may be used to finance other state departments. It offers essential services which may not be offered in private sectors. Prices are kept reasonable. Wasteful duplication of services is eliminated. Planning can be coordinated through central control. It generates income to finance social programs. Jobs are created for all skill levels. Now we're looking at the disadvantages of state-owned companies. Sorry, I should have moved that down below just to separate it. Sorry for that. It may result in poor management as the government is not always as efficient as the private sector. Efficiency due to the size of the business often relies on government subsidies, a lack of incentive from employees to perform if there is an absence of their motivators such as productivity bonuses, a lack of incentives of employees to perform if there is no share in the profit. Government can lose money through the business. Losses must be met by the taxpayer. Shares are not freely tradable, making it difficult to raise capital. SOC must follow strict regulations for operations to raise capital, and financial statements must be audited. Now we're looking at non-profit companies. Okay, I think it says it in its name that it does not make money. It is non-profit companies. A non-profit company may register with the Department of Social Welfare as a non-profit organization. In terms of the Non-Profit Organization Act, to apply for government funding or to obtain a fundraising number, a non-profit company must comply with ongoing administration requirements set out in the Companies Act, including the filing and annual returns and annual reporting. Characteristics of an NPO. Non-profit companies do make money, but they do not make a profit. So that's where I've explained in previous videos. Often these non-profit companies will have like a little thrift store in the front where they're selling books, they're selling clothing, they're selling maybe old machinery. So they do make money, but they don't make enough to cover the costs of those goods. So therefore they're not making a profit. So they get the money in and they're raising funds, but they're not actually making a profit. Because in order to make a profit, we need to make a product and make sure that we are covering our expenses. That's how we make a profit. Any money raised by a non-profit company needs to be used by the company to cover its expenses. The name of a non-profit company must end with NPC, non-profit company. The advantages of an NPC. The company has its independent legal personality, but directors are liable for any loss, damage, or cost sustained by the company if acting in the nature of the company. The assets of the company are in the name of the organization, not by the members. Non-profit companies continue to exist even if the membership is changed. That's where we spoke about it has a legal personality. The assets and liabilities of the organization are held separate from those of its members. It may make a profit but not share any of these profits with the members. Profits can only be used to conduct the work of the organization. So if there's any profits being made, it needs to go back into the business to help to build another toilet, or maybe to build a classroom, or whatever the case is. All of a non-profit company's assets and income must be used to advance its stated objects as set out in the MOI. The members exercise power in general meetings in the sense that they can appoint or remove directors and amend the MOI of the company and dispose of NPO's assets. Non-profit companies must prepare the financial statements at the end of the year, and they are not compelled to audit the financial statements. Non-profit companies are not compelled to attend AGMs, annual general meetings. So here's the difference between the forms of ownership. So when starting a business, it is important to choose the form of ownership that will be profitable. Each of these forms of ownership function differently, as we've seen. It is therefore important to evaluate each form of ownership carefully. Okay, I'm not going to go through all of these, so I would advise that you pause the video at this stage and you read through them. The reason I'm not going to go through it is because I'd be repeating myself as we've gone through it in detail. This is just, as you can see, a snapshot. If we look at private company and public company, the one ends with Pty Ltd, the other one ends with Ltd. So this is more of a summary of what we've already discussed. All right, and then just continuing the difference in the form of ownership of companies, private company, personal liability, state-owned, and non-profit. All right, the benefits of establishing a company versus other forms of ownership. So, legal status and liability. A company has its own legal status, trading name, and its own assets. Where we spoke about a sole trader and a partnership, do not have that. Shareholders' private assets are protected as they have limited liability. The shareholders have no direct legal responsibility. Companies have their own names and these are protected. Profit sharing. Shareholders share in the profit of the company in the form of dividends. Other forms of ownership will share profit according to the contribution or internal agreement. Ownership and management. Shareholders are able to buy and sell shares freely in a public company. The company is managed by a qualified and competent board of directors. A company is less likely to use consultants as it has a large pool of skills and experts. Directors are more likely to take risks and allow growth opportunities for the business. Some of the other forms of ownership, for example, sole proprietor has to rely on his or her own abilities to manage the business. Capital and cash flow. A company may have more investors to fund the setting up of the business. Companies have a better cash flow than sole traders. A company is not limited to the individual contribution of the members of capital. The long-term growth opportunities for companies are good as there are always possibilities of getting more investors. Directors do not have to take personal loans to grow the business. Companies have a bigger potential to gain capital than other forms of ownership. Lifespan and continuity. A company has a continuity of existence. Companies' shares can be transferred, bought, or sold. The lifespan of a sole proprietor and partnership is limited. Then we're looking at taxation. Companies have tax benefits that other enterprises do not have. They may obtain tax rebates, which means you get less tax, if they are involved in social responsibility programs. Allowances made for companies such as tax-deductible business expenses are day-to-day expenses like materials and equipment costs, employee costs and administration costs, business, office and rental costs, capital expenses, education, entertainment, and business startup expenses. The lifespan of a sole proprietor and a partnership is limited. Then the challenges of establishing a company versus the other forms of ownership. To set up a company is an expensive and complicated procedure with many legal requirements that follow. If the directors are not competent with the shareholders' investment, this may be at risk. Some of the challenges of setting up a company versus other form of ownership includes the owners of a company have more liability. Directors might not have a personal stake in the company. If a director changes, there may be differences in the continuity of management. Directors may not have a personal interest in the business, and this could prevent the business from gaining help to maximize profits and growth. There may be a conflict between the owners of the company and the management in control. Politics can get in the way, and directors are appointed maybe for the wrong reasons. A company may cease to exist if it is deregistered from CIPC. Then the challenge is continuing. Directors do not have a personal interest in the business. They might not attract investors. The limited liability aspect of the company generates more paperwork in the registration process. When directors change, there could be a lack of continuity in management. Companies have more taxation requirements. The more shares there are, the less profit per share. A large amount of money is spent on financial audits and accounting fees because of government regulations. Companies must disclose all financial information. This could provide their competitors with an unfair advantage. State-owned companies often deliver non-profitable services that lead to the government losing money through the business. Then the procedure for the formation of companies. We need to determine the people establishing the company. We need to prepare a memorandum of incorporation, open a bank account, and register for taxation. File a notice of incorporation and obtain a unique registration number. Draw up a prospectus for potential investors. Register the company at the Companies and Intellectual Property Commission. A company becomes a legal entity once registration has been finalized. A company is registered and may start doing business once the name has been approved, the prescribed fees have been paid, a notice of incorporation has been lodged, and the application to incorporate a new company has been processed by the CIPC. The legal requirements of the name of a company. If a name is reserved at the CIPC, it cannot be used by another company. Names can be reserved by a business for 6 months. The name of a business is subject to the approval of CIPC. The name of a company must be original and not misleading. A company's name must appear on all the company documents. The name of a company must show the type of company. So for example, if you've got a non-profit company, it needs to end with NPC. Personal liability needs to end with Incorporated. Private company needs to end with Pty Ltd. A public company needs to end with Ltd. A state-owned company needs to end with COC Ltd. The name of the company must not be offensive. It must not promote violence or hatred or cause any harm. The name must not be shortened or translated. A company is not allowed to use a misleading name. Understanding the Memorandum of Incorporation, Notice of Incorporation, and the Prospectus. Memorandum of Incorporation, the meaning. We've spoken about it a lot in this video, so let's get down to the basics. Let's see what it actually means. MOI serves as a constitution of a company. Companies are governed according to the rules stated in a MOI. MOI includes information about the company's name, the registered office, and the records. MOI describes the relationship between the business and its stakeholders. MOI describes the rights, the responsibilities, and the duties of shareholders and directors. MOI provides details about the incorporation, the number of directors, and the share capital. The aspects that have to be included in a Memorandum of Incorporation include the name of the company, the nature of the company, the main objectives of the company, the securities, so the shares, the directors and officers, the extent of and restrictions placed on directors' powers of authority, how the company will operate in terms of acquiring and disposing of assets, and other procedural and administrative issues. Shareholders, meetings, and procedures need to be included. The number of shares each incorporator will purchase needs to be included there. The amount of share capital that's registered, the rules and regulations of the company, and the name of the auditor. Notice of Incorporation. The notice must be lodged together with the standard form of Memorandum of Incorporation, and it will contain the following information: the type of company, the financial year end, the number of directors, the incorporation date, the registered address, and the company name. Prospectus. A prospectus is a written invitation to the public to buy shares. The shares of a company are transferred. The shares of a company are referred to as the company's securities. Before a company can be registered, the company must approve that enough shares have been issued to cover the launching cost and essential initial expenses. This is called the minimum subscription, and the shares must be sold within 60 days of issuing the prospectus. Otherwise, the public company may not commence business. The meaning of prospectus. A prospectus is a written invitation to convince the public to buy shares. A prospectus gives information about the business. It is a formal legal document giving details about the investment offerings. A prospectus must be issued by a company within 3 months after the date of registration. The meaning of the initial public offer, IPO. This is when a company issues shares to the public for the first time. The company must produce a prospectus before undertaking the initial offering. Most companies must undertake an IPO with the assistance of an investment bank firm acting in the role of an underwriter. The prospectus continuing. The meaning of a second offering. A second offering is an offering of securities by a shareholder of the company as opposed to the company itself, which is the primary offering. A secondary offering is the sale of a new or closely held shares by a company that has already made the initial public offering. So, aspects that need to be included in prospectus. There's quite a few there. The name of a company. The company overview, which includes the vision, mission, goals, and objectives. Product or service portfolio. So what are all the different product offerings or services that we have in our business? Market analysis and strategy. Management team. The risks and potential of the business. The available financial and share information. Company's assets and liabilities. Financial position. Profits and losses, cash flow, prospectus for growth, pre-incorporation contracts that have been signed, date of registration of the prospectus, minimum subscription, preliminary expenses, property that's owned, shares issued, share capital, and the purpose of the offer. All right, we've reached the end of the video. Here is the mind map recap of what we have been through in the video. It was quite a long video today. It is quite a big chapter, so there was just a lot of content to get through. And then here are the resources that I've made to make the slides and the video content for today, which I will include in my description below. I want to say thank you very much for watching my video today. I see that I'm posting a lot of longer form videos lately. I think it's just because these chapters have a lot of content and I like to do them all in one part. Some may disagree. I should do a part 1, part 2, part 3. But in my mind, a person can always come back to the video, if that makes sense. So you can watch it in different sections. You can revisit and rewatch the videos. So whether it's in a part 1, part 2, or part 3, if I do it all as one, then you can keep coming back and watching the parts again. But I just want to thank you for watching my video today. This is a huge chapter, part of grade 11's content, which often means and indicates that it could be a potential essay question. So just look out for that. But thank you so much. Please hit the like button if you learned something new today and if you found this to be informative and knowledgeable. And please consider subscribing to my channel. Again, thank you for all the support of my channel. And it's so awesome to see how my channel is growing and expanding. And I can only thank you guys for that, because if it weren't for you guys, this channel wouldn't exist and I wouldn't see the growth that I'm seeing if it weren't for you. So thank you so much, guys. All the best with your June exams. I hope to see you in my next video. Bye for now.